Joined right now by Jake Walthour. He is the CEO and co-founder of Blueprint Capital Advisors. And Jake, why don't we start with technology before we work our way into the reopening stocks? Because technology, you're a little concerned, has come too far too fast and could be what leads us into any sort of correction at this point.
Sure. Thanks for having me this morning. I have been bullish on tech for a long time now, and I continue to be bullish on tech for the foreseeable future. In fact, on the long-term basis, the next 5 to 10 years, we think creative destruction is where money's going to be made. But I think over the short term, investors are getting a little jittery about tech stocks. I mean, let's face it, the FANG names have run quite a bit here. And from a valuation perspective, they make a lot of people nervous. Having said that, I think the business models are still intact. We just may struggle to get out of these trading ranges over the short term. And so we're turning our attention to some other names that we think will do very well once the vaccines are in place and people start to travel more. We think the real money is going to be made over the next 6 to 12 months, really in the consumer space. And when we think about the consumer, what we're thinking about is what are the things that they miss the most? Restaurants and bars and travel. And so when we think about travel, we think about the airlines, we think about Southwest. Great company, seems to be the darling of consumers, and focuses a lot on domestic routes. And so we don't have to worry about international travel restrictions. On the hotel side, we like Hilton. I mean, what most people don't know about Hilton is that Hilton doesn't own a lot of hotels. Hilton's a franchise company with great recurring cash flow, sort of Buffett-esque. Then in the alternative accommodation space, we really like Airbnb. It's global, it's the leader in its space. And it doesn't take a lot of risk. And I think Airbnb, more so than a lot of other companies throughout the pandemic, realized that it doesn't need to spend as much on advertising. It doesn't need as many employees. And the company is going to do well on a lower cost structure. Just in January alone, they had 49 million inquiries for places to stay in 2021. So we're pretty excited about the consumer here over the short term.
Hey, Jake, I'm with you 100% in terms of consumer behavior and what that might mean. I think a lot of people are really eager to get back out there and do things that they haven't done in a long time. But the stock market's kind of figured that out. That's why a lot of these names are trading above the levels where they were before the pandemic ever hit. Why do you think there's more room to run in those stocks?
I think there's more room to run, one, because we've got a really large fiscal stimulus package coming out of Washington. Second, I think interest rates will remain low for the foreseeable future. We flirted around with interest rates rising, but really haven't seen anything that I think is harmful to the overall stock market. And third, I think we're going to see a high rate of GDP growth coming off, relatively low basis. But I do think that those three factors will continue to drive the market higher. Right now, when you think about interest rates, investors don't have a lot of other options. And although we've been talking about most of the companies, which I mentioned today, hitting new highs or being very close to their 52-week highs, there's still a lot of room to grow when we think about what the earnings numbers are going to look like for the next 2 quarters.
Let's look at some of the restaurant stocks specifically, because you mentioned Cheesecake Factory and Darden. Cheesecake Factory has gone to $56 from $14. Darden's gone to $130 from $26, and those are some big moves on these names that we've seen come in. You think that even despite that, these are names that you want to be in, because why?
Look, I think the restaurant space, for the most part, all the restaurants were shut down, and so those numbers that we're comparing them to some extent, I'm a little bit dismissive of them. Look, I think at 14, going to 56, no one expected Cheesecake Factory to put up performance numbers like a tech stock. However, it's a solid business. And when the consumer starts to dine again, I think you're going to see that these companies have done a lot to rationalize their cost structures. And I think you're going to see greater than average demand for what they do. And so I like Cheesecake Factory. I like Darden a lot because of its diversification. And I think that the numbers, again, in the third and fourth quarter are going to be very exciting numbers relative to what expectations are.
Shepard Smith here. Thanks for watching CNBC on YouTube.